our development team's done a tremendous job of really growing that platform for us. Just a couple of years ago, our development was somewhere in the $300 million range, and we're approaching $1 billion to $1.2 billion. We've got another 5 or 6 projects that we should start next year if the economic conditions continue to support that. Given our balance sheet size, where our leverage is, we have ample capacity to be able to execute on that while maintaining that A- credit rating as well.
So Brad, MAA faced several headwinds in the third quarter. How did they impact results, and how is MAA positioned as we head into 2026?
Well, I think the headwinds that we faced in the third quarter are not dissimilar to what we've really faced all year long, and really that's consumer confidence has declined. We've seen a slowdown in the job growth front, and certainly economic uncertainty. And really where that's impacted us most is on the new lease rate side. New lease rate performance was softer in spring and summer leasing season versus what we had originally expected for the year. But all other parts of the business are performing quite well, and I think that really sets us up well for 2026. As we sit here today, have full confidence in our ability to execute on the things that we can control. Some of the building blocks that we have in place for 2026 we're pretty confident in. And certainly excited about as we enter 2026. Our new lease rates, our retention rates, our occupancy are all performing better this time this year than they were last year. So we feel good about that setup for 2026. And certainly with a supply environment next year that is expected to decrease between 30 and 35%, we expect that new lease rate performance really to grow next year and to build throughout the year. So we're pretty excited about what that could look like next year.
And can you discuss how you balance growth between new development while maintaining financial flexibility?
Yeah, well, I think, on a REIT platform, flexibility is extremely important for us. Excuse me. And we have, A- credit rating, which maintaining that is a very high priority for us. So I think in terms of balancing, if you look at our balance sheet today, one of the strongest in the space, 4.2 times leverage. Probably optimal leverage for us is 4.5 to 5 times. And so what that means is, we probably have the capacity to increase our leverage somewhere in the $1 billion to $1.5 billion range. And predominantly for us, that's going to come through growing development. And, our development team's done a tremendous job of really growing that platform for us. Just a couple of years ago, our development was somewhere in the $300 million range, and we're approaching $1 billion to $1.2 billion. We've got another 5 or 6 projects that we should start next year if the economic conditions continue to support that. Given our balance sheet size, where our leverage is, we have ample capacity to be able to execute on that while maintaining that A- credit rating as well.
So MAA has historically focused on Sunbelt markets with strong population and job growth. How do you see demographic shifts such as migration patterns and remote work trends influencing your long-term market selection strategy?
Yeah, well, demand by far, we believe, is the component of the business that's most highly correlated with long-term performance. So we do focus on all aspects of demand that you mentioned, whether it's in our current markets or new markets that we're looking at. And really what we've seen in our region of the country, we've seen certainly a low tax rate environment, pro-business, really support an ability for our markets to take an outsized size of the demand pie, so to speak, and we've seen that historically and certainly expect that to continue going forward. It's interesting, we had an executive property tour yesterday with a number of analysts and investors. We had Jay Parsons, the economist, come talk with us, and he showed a slide where he showed the demographics of the 20 to 39-year-olds, and he broke it down into 2 buckets. One was the top 9 markets, which were, and I'll probably forget some of them, but South Carolina, North Carolina, Georgia, Tennessee, Texas, Florida, Arizona, Colorado, and Utah. All markets that we're located in, and then he showed the other 41 markets. And it's interesting, if you look at the demographic shifts in that cohort, what you see is the year-over-year change in population growth declines starting in 2024, but the bucket for the other 41 markets goes negative starting in 2028. But if you look at that top 9 markets, it stays positive. The year-over-year change stays positive out through the study period of 2033, and I think that really encompasses the demand dynamics, the demographic shifts that we're seeing in our markets. A lot of the demand that we're seeing is coming from these other markets, and that's the demographic shifts that I think has benefited our portfolio and continues to benefit these high demand, high growth markets that we're located in, and certainly don't see that changing in the future as that chart showed, which really supports the apartment rental market for the future in our markets.